All right, so we're picking up on learning objective 6.3. And before we push into this 6.3, I kind of want to go backwards just a little bit. Last video was getting a little bit long, and I kind of wanted to show you the journal entries. We learned the journal entries back in chapter 5. These are the exact same journal entries. It's just taking it from these little charts that I did and then understanding what those journal entries were. So realize right here is a sell. That's when we're selling units. So if you look right here, this was the one for weighted average. And where's the sell? There's the sell right there. The 14, they actually rounded to 1427. So that sell right there was right here. Okay. Um, when we purchased the inventory, that was the purchase. Debit the merchandise inventory, credit accounts payable. Okay, so all of those journal entries you've already learned, so just don't forget them. The only thing that's different between the journal entries in these three different methods are the numbers. Okay, they're exactly the same. Okay, just the numbers changed because remember, the layers changed as we went through all of those methods. Okay. So on this video, or this learning objective, we're going to kind of compare and contrast these three methods to each other. Okay. How does this affect the income statement and the balance sheet? Because each method will have an impact on the financial statements. Okay. Before we have the words, I kind of like to come down here. We calculated, now I didn't really do the specific identification, so I'm just kind of going to skip it. I'm just going to block it out for right now. Um, and you can see the cost of goods sold. Okay. Notice right here that with LIFO, it created a higher cost of goods sold, which is an expense. So a higher cost of goods sold will produce a lower net income. I sometimes, if I'd have wrote these out, I would have put the average one right in the middle because you can see the number is right in the middle between LIFO and FIFO. Okay. Um, and then let's come down here and let's talk about FIFO. FIFO creates the lowest cost of goods sold. Okay. Which would create a higher net income. Okay, now this only happens in a period of rising prices. Okay, so I'm going to come back over here. When I say a period of rising prices, their beginning inventory was 350. They purchased some inventory for 360 and then they purchased some more for 380. That's a period of inflation or rising prices. So these little things only hold true when you're in a period of rising prices. When you get in a period of deflation, the opposite will happen for all of these. Okay. And before we kind of move forward, let's kind of talk about which companies probably use which one the most. Okay. Weighted average really does good. Like, I always think of oil and gas because those prices get very volatile. They have lots of dips and peaks, and the average would smooth that out just a little bit. Okay. But a lot of companies actually use LIFO, and you're probably thinking, why would anybody want a lower net income? Think about why you would want lower taxable income on your taxes when you do your taxes sometime next year between January and April 15th. They want that lower net income so they can save money on taxes and they're not having to pay as many taxes. Okay. So let's kind of look at the balance sheet and we calculated the ending inventory, okay, on all of those. So you could pull every one of those numbers from that. They actually went through and showed you beginning inventory, purchases, goods available for sale, and then minus the cost of goods sold leaves us with the ending inventory, but we calculated that on each one of those. Okay, so ending inventory underneath FIFO, now this is the balance sheet. Okay, so this is making our assets higher. Okay, making our assets higher. LIFO is making the assets lower. Okay. Again, that only happens in a period of rising prices. Okay. So I could argue all three of these, but remember, we kind of go back to that consistency principle. A company can't just switch back and forth. If they decide to switch, they may be in business for 20 years using LIFO, and if they decide to switch, they've got to restate 20 years worth of earnings based on that consistent application of whatever they switch to. Okay. So it has to be consistent so they can't just change whenever they want to. Okay. And I will see you in the next video. Learning objective 4, 5, and 6 will be on one video.